Is it true that borrowers with good credit obtaining a conventional loan will be paying more after May 1st? Today, we're going to delve into it and discuss what buyers really should be focusing on right now. There is a new rule starting May 1st that will increase the cost of a mortgage for those of you with good credit scores and down payment around 20%. Yes, the things that would normally guarantee you a really good interest rate. So it is true that if you have a good credit score, you might not get as good of a deal. There are articles and headlines talking about this everywhere from MSNBC to Fox News and everything in between. So I felt the most neutral of anybody reporting on this was from Mortgage News Daily, and we're going to kind of explore their outlook on it. So they say that on average, with a borrower who has a credit score of above 680 will pay on average of about $40 more a month based on just a $400,000 mortgage, right? So that's $480 more a year and $14,400 over the course of the entire loan. And they go on to explain that a certain type of mortgage fee, the structure of that fee is what's changing. And it can be part of your closing costs, but typically it's rolled into your mortgage in the form of a slightly higher interest rate. And it states that while it's coming into effect on May 1st, a lot of banks have already begun to price accordingly. So essentially, here's the crux of it. The effective penalty for having a credit score under 680 is now smaller than it was. So it still costs more to have a lower credit score. For instance, if you have a score of 659 and are borrowing 75% of the home's value, you're going to pay a fee equal to 1.5% of the loan balance, whereas you'd pay no fee if you had a 780 plus credit score. So now the fees are going down slightly for those with lower credit scores and going up for those who have higher credit scores. So they show a heat map of those who will feel the increases the most. So everybody at the top still pays lower fees. Everybody at the bottom still pays higher fees. And this shows the adjustment of whose fees will be going up and whose fees will be going down slightly. And you'll see that those who have credit scores between 720 to 760 and down payments around 20%, i.e. the ideal buyer or where most buyers aspire to be, they're going to be paying the highest fee. And while this is probably shocking to a lot of you, there will be those with lower credit scores who will actually really benefit. So instead of the people with lower credit scores paying 13 times as much in fees as people with excellent credit scores, now it'll only be about 7 times as much. So one can argue that it's not punishing those with good credit, it's just rewarding them less. So they're still gonna pay lower fees than somebody with lower credit scores. So I think because you're hearing people about that, well, maybe it makes sense not to pay my credit cards, or maybe I need to default on payments so I can get that lower rate. You should not be doing that. Anyone that's telling you to do that is giving you the wrong advice. Again, those with the lower credit scores are still going to be paying higher fees than those that have really good credit. So you still want to strive to make sure that you actually have really good credit. So I think for me, what seems wrong about this is really the timing. I think with housing prices so high, the interest rates are high, and in the midst of the spring buying season right now, I think the one thing I would take away from this is maybe this probably wasn't the best time to actually initiate this program or these rules and making these fees either higher and lower depending on where you fall into it. So it still, again, makes sense that you want to have the best credit score since in addition to the fees, there is the interest rate. And those with the higher scores, their rates are going to be lower. So in addition to those fees, there's also 2 new levels that have been added to the structure. And in the past, generally anybody over 740 credit score was considered top tier. Now that your top tier pricing that you see for interest rates that most mortgage lenders, brokers, banks advertise, it's going to be based off the top tier, which is 780 and higher. So now they have 760 plus, 780 plus. So if you have a 780 plus and your down payment is around 20%, you will be better off. If you are over 20% down, you will be the same or benefit. And if you are just 5% down or less, you really benefit. In fact, everybody benefits if they're that 5% or less, as you see here on this chart. So maybe this is just a recognition of the sign of the times, and it's harder to come up with 20% down, or the government wants people to be in debt, and it's a huge conspiracy that they want you to take out a larger loan. I don't know. I don't know the answer. I'd be curious to hear what your thoughts may be. But one thing that buyers really should be focusing on that really nobody's talking about, and a lot of lenders have kind of already began to bake this into their rate, is what your DTI is. And the DTI is debt to income ratio. And so if your debt to income ratio is above 40%, they're going to ding you for a slightly higher interest rate. So at the end of the day, what's the moral of the story? You really need to talk to your lender right now. You know, maybe you were considering going FHA, but maybe now it makes more sense to go conventional, and vice versa. You need to look at all your options on the table when you talk with a lender, because there's so many moving parts and things are constantly changing. We always recommend talk to a lender as soon as possible if you're thinking about buying a home. I know I really threw a lot at you today, so if you have any questions, feel free to reach out to me. You can send me a message. You can always call me, 818-396-3311. That's 818-396-3311.